Senhoras e senhores, o nosso próximo painel será conduzido em inglês. Então, todos aqueles que quiserem ter acesso à tradução simultânea, por favor, se direcionem agora à minha esquerda, à direita de vocês, para pegar o aparelho para a tradução simultânea e, por favor, levem um documento de identidade para poder, de fato, conseguir obter o aparelho. Feito essa observação, seguindo adiante, eu gostaria de convocar ao palco agora ele, que é diretor financeiro do IFL São Paulo. Vem ao palco, por favor, o meu amigo Felipe Parceiro. Felipe? Tudo bem, amigo?
Boa tarde a todos. Na primeira temporada de La Casa de Papel, o protagonista da série, o professor, justifica o roubo e a impressão de 2,4 bilhões de euros com a seguinte fala, abre aspas, em 2011, o Banco Central Europeu criou, do nada, 171 bilhões de euros. Do nada. Igual ao que a gente está fazendo. Alguém disse que o Banco Central era um ladrão? Chamaram de injeção de liquidez. Eu faço uma injeção de liquidez, não para os bancos, mas para a economia real desses pobres coitados. E fecha aspas. De janeiro de 2020 a julho deste ano, o Banco Central Europeu fez uma injeção de liquidez de mais de 2 trilhões de euros. O que é 830 vezes maior do que o professor falsário pretendia fazer. O Fed foi mais ousado, 1.700 vezes. O Banco Central do Brasil não fica muito atrás. Injetou 670 casas de papel na economia brasileira. Von Mises, autor liberal, presente no ciclo de formação do Instituto, defende que a inflação é simplesmente o aumento da oferta de dinheiro. Nos últimos meses, a inflação americana chegou a 5,4% ao ano e a brasileira a 9,7%. Diante desta realidade, o novo líder faz a seguinte pergunta: como investir nesse cenário de injeção de liquidez? É possível alocar recursos dentro de uma relação de risco-retorno que faça sentido? É possível investir e ter retornos consistentes acima da inflação? O líder deve estar atento às novas tecnologias financeiras. As criptomoedas são uma proposta para modernizar o dinheiro e adotar meios de pagamento descentralizados. Um tema bastante falado nos últimos tempos foi a sigla ESG, e os líderes devem estar atentos a essas mudanças. Os investidores optam por direcionar seus recursos a empresas que contribuam para causas ambientais, sociais e de governança. Para uns, é uma forma do setor privado se comprometer com as mudanças sociais. Para outros, é a transferência de riqueza de empreendedores para consultores sem skin in the game. Para debater as novas teses de investimento, chamamos ao palco o professor Damodaran e o conselheiro do IFL São Paulo, Florian Bartunek, com a mediação de Fernando Ulrich.
All right, so good afternoon, everyone. It's a real pleasure and honor to be taking part in this Liberty and Democracy Forum. And before going directly into the questions, let me just make a more complete introduction of our panelists. So starting with Professor Aswath Damodaran, who is a professor of finance at the Stern School of Business at New York University, where he teaches corporate finance and equity valuation. Known as the Dean of Valuation due to his expertise in that subject, Damodaran is best known as the author of several widely used academic and practitioner texts on valuation, corporate finance, and investment management. Welcome, Professor.
Thank you for having me.
And next to me sits Florian Bartonek, who is one of the most renowned fund managers in Brazil. In 2002, he founded Constellation, an asset management with more than 2 billion reals under management. Besides being the CIO of Constellation, he is an active board member in several institutions related to education in Brazil, like Lehman Foundation, Proa Institute, Estudar Foundation, and others. So let me start with Professor Damodaran. I'm not sure if you were listening to the introduction of the panel, but our finance director was telling the story of that Netflix series Money Heist, and how the central banks in the last 12 years printed a lot of money. But let me start with a more broad question in terms of investment, valuation, which is the following. Has there ever been a more challenging time in terms of selecting businesses, valuing companies? Because we have not only all these active monetary experiments, but also fiscal experiments. We are just going out, or perhaps still in the middle of a major pandemic. We have disruptive technologies. We have money-losing companies that are worth hundreds of billions of dollars. So how do you view this whole, the current paradigm for valuing businesses?
You know what? It's a hubris of every generation that it is special. We live in special times. We live in difficult times. Come on, during the Black Plague in Europe, where a third of Europe's population got wiped out, you think people didn't have it more difficult? I mean, I think we were spoiled by the 20th century. The 20th century, if you look at the long history of humankind, was a century where, especially the second half after the Second World War, where things were more stable than they've ever been before. So in my view, we're just seeing a return to history. And I think that there is a lot of disruption, a lot of change, but I don't think that it's that unusual. I think it is part of human evolution that we'll go through these periods, and this too shall pass.
Florian, what's your take on this more broad question?
Well, I just want to make a quick comment.
Of course.
Professor Damodaran will probably not remember, but I wrote the foreword for his book, the Brazilian edition of his book. And this was back in 1990, I don't know, 6, 7, 8. Probably
we're both giving away how old we are by letting people know when that was done. Yeah.
But you always look very young. You always look very young. But and Professor Damodaran was very kind to talk to my team at Banco Pactual at that time in Rio de Janeiro. Probably the first time you were in Brazil,
that
right?
I remember. The first time I was in Brazil.
Yeah, in Rio, right? So, well, so it's a pleasure to meet you again. But so I think that, so when you look at the way and I'm going to concentrate in this part of the answer in equities, right? Because there's so many different things we want to talk now, different asset classes and stuff. But so I think the basics of valuations are the same, right? The basics of investing are the same as human beings haven't changed and won't change probably, right? I'm writing the foreword to the Brazilian edition to the Reminiscence of a Stock Operator. So I had to read the book. I had to read the book back, right? Again. So, and the book is like 100 years old, and it's the same story as today. Same things: greed, fear, excesses. Right? So human nature is the same. Valuation shouldn't change. It shouldn't change, right? What changes is on the surface is business models, the rate of change of businesses, right? So the way companies grow, right? Companies are, when you compare this decade to like
20 years ago, maybe some companies are growing faster than they used to, right? Due to network effects and new products, new services. So. But by and large, valuation doesn't change, at least for me. Of course, some people have to justify valuations, given that the rate of change is accelerating. You have to look much longer in the future to find value, and you have to justify that using different ratios, like price to sales, or right? But by and large, I don't think things change much. But the big challenge for us is not valuing this business. It starts with the parameters you use. So growth, right? So moats, the sustainability of moats. I think that's a big question mark right now, right? In Brazil, Professor, like 30 years ago, when we looked at the big banks, there was no question whether the business model was right. There was no question if the banks were sustainable. The question was, look, how are interest rates going to be? What's the macro going to be? But we never doubted the business model. We never doubted the moats that banks had in Brazil. And now I can't see more than 2, 4, 5 years in the future regarding the. So I think the big change is in the business models, not so much in valuation, and human nature doesn't change, I think.
The one thing I would add to that is I'm a great believer in corporate life cycles. That companies are born, they become teenagers, then they grow up, they grow old, and then they die. And if you look at the great companies of the 20th century, they had long life cycles. I give the example of GE. GE was founded in 1892, and it had a good run. Now it's a walking dead company, but it had a 120-year run. In contrast, think of Yahoo. Yahoo was founded in 1992, became a $100 billion company in 7 years by 1999, peaked in 2004, and was gone by 2015. In fact, I say only half jokingly that tech companies age in dog years. A 30-year tech company is like a 200-year manufacturing company. And the reason I bring this up is almost everything we know in business and valuation was designed for companies like GE. I'll give you an example. When you do discounted cash flow valuation, my domain, when you get to year 5 or 10, what do? We stop estimating cash flows and we assume cash flows continue in perpetuity. Now, when you have a 125-year life, that's not a big deal. But if you have a 20-year life or a 25-year life for a company, using that practice is going to get us into trouble. So one of the things I would encourage people to do is take everything you learn in books, because everything you learn in books is for the GEs of the world, and ask yourself a question. What should I do differently given that we're looking at companies that are going to grow far faster than those old companies, but they're also going to shrink far faster than those old companies? So I think it requires that we re-examine things we take as truths and look at them through the new lens of, hey, we live in a world where companies are going to grow fast and they're going to die fast. One of the, I don't want to filibuster, but one of the things it's creating is, when you think about the perfect CEO for a company, the perfect CEO for a company should match where it is in the life cycle. You take a company like Ford. Now, Henry Ford was the perfect CEO when it was a growing company, but it wouldn't have been a perfect CEO once it became a mature company. In today's day and age, the same CEO is running the company when it's a startup and when it's a dying company, and that's going to create quite a few problems in terms of a mismatch.
And
Go ahead, please.
No, because I think Professor Damodaran is absolutely right. You need different skills in different life cycles of the business. So Henry Ford was an entrepreneur. Sloan at GM was the operator, right? And then Lee Iacocca at Chrysler was the one that brought the company back, right?
Turn around.
The reincarnator. The reincarnator is what I call it. Yeah.
Exactly, right? And for investors, and given that the rate of change is increasing so fast, for you to be a good capital allocator, you really need to understand business models and adapt very fast as an investor as well. So if the life cycle of companies, as Professor is saying, is shorter, you have to study much more and adapt much faster and be much more flexible. Again, keeping your fundamentals very strong. When we talk about liberty, Hayek, Friedman, I always say, look, the fundamentals stay the same. Never, never forget the fundamentals. The books from Mises or Hayek are the same. They're as contemporary today as they were decades ago. So never forget the basics of valuation. But you have to be much faster in adapting to understand, to be a better capital allocator.
So in terms of, since we're speaking of corporate life cycles, the last 15 years have brought into life some companies that perhaps wouldn't have existed 50 years ago because of very low rates and cheap and abundant capital. So how has this paradigm of zero interest rates and abundant capital impacted the business of valuation?
Am I on the dock here?
Yeah, go ahead, Professor.
Yeah. It's changed the types of companies that can go public, right? I mean, 50 years ago, if you're a money-losing company and you're burning through cash, you didn't go public. You depended on the largesse of venture capitalists who had limited capital, and essentially you stayed small. Today, the access to capital for young money-losing companies is almost limitless. I mean, look at a fiasco like WeWork. Think of how many billions of dollars got poured into WeWork before the company blew up. So there's a plus and a minus here. It does mean that younger companies which are losing money, which are burning through cash, now have access to capital that allows them to survive. But it also means that in some of these companies, we're going to burn through tens of billions of cash before we wake up and say, that was a mistake. So I think that that access to capital is always a double-edged sword, and we're seeing kind of the downside and the upside of that today in markets.
And Florian, how does this affect Brazil? Because capital is global, abundant liquidity abroad ends up in our country as well, but our domestic rates are almost back to double digits. What is the difference in terms of capital abundancy?
No, I'd say that when there is too much money, there are the malinvestments, right? So normal cycles, once you understand the word works in cycles, you're okay. Just don't get overexcited, don't get over pessimistic. I think that low interest rates, you have to be more selective. You could have two strategies. Either you, like they say, spray and pray. Say, look, I don't know which one of those 4 banks is going to be the new bank or the new bank. So I'm going to make a small investment in all of them, given certain hurdles, right? Good management, ethics, blah, blah, blah. Right? Or you think you can choose one. So either you choose one, or you go to invest in the 4 of them. Definitely, when you look at the market cap in some industries, it's much higher than it should be given the profit pool. And the market cap is much higher because people don't know who the winners are going to be. So if you add, the profit pool in banking in Brazil is stable or coming down because fees are going down, right? So the whole profit pool for the finance industry is stable. It's not going down because public banks are getting out of the market, but if it wasn't for the public banks, the profit pool would be going down given that fees are going down, right? But the market cap is 3 times higher today than it was 10 years ago, because you add Nubank, you add Mercado Livre, which is a finance company to some extent, right? You add XP, who didn't exist as big as it is now a couple of years ago. So there are excesses. It's harder to kind of choose, definitely. But the basics of business, so picking the good companies that have pricing power, because too much money, high inflation, and sometimes the best hedge is a company that can raise prices, right? As Warren Buffett says, right? So that's kind of the way we look at it. And there is the other asset classes, the scarce assets that Professor Damodaran has very interesting papers based on this different kind of asset class, which is scarce assets, that also raising prices, because actually the currency is going down. So it's not that everything is going up, but the value of the currency is going down.
So now that you've touched upon the question of inflation, let me turn to Professor then, because we've seen the highest inflation readings in the last 30 years. If you take the core CPI, it's almost 5%, the highest since 1991. How is this affecting businesses, and how is this affecting the growth of companies and also the business of valuation as well?
You know, it's when people ask me about markets, I'm not a market timer generally, but when they ask me what's my biggest fear in markets, I tell them it's inflation. And part of the reason for that is I'm actually blown away by people who seem to think inflation is not an issue. Maybe because at least in the US and Europe, many younger people have never lived through a period of high inflation. So they act like inflation is just like any other problem. You put it in the bottle, you put the top on, it's going away. I came into markets in 1979. That was the year when you had double-digit inflation in the US, and you actually had to have one of the most severe recessions since the Great Depression to bring inflation down. So right now, inflation is high. You know, the excuse that people who want to give excuses give, it's COVID, it's supply chains, and once it passes, inflation is going to go away. Yeah, I'm not so sure. I think we're being very casual, and by we, I include the Fed. I am sick and tired of Fed chairmen and central banking chairs in general saying, don't worry about inflation, we'll take care of it. Because I want to hear less from them and see them do more about inflation, because inflation has never been good for financial assets. When you come from a country like Brazil, especially if you're older, you can see the damage, the demolition that inflation can do to financial asset classes. So I remain scared. To me, that is my biggest concern. And it's a concern because there's no place to hide in financial asset classes. Everything is exposed when inflation goes up.
Florian, I also want to have your take on the subject of inflation, because it's very important. And as Professor Damodaran said, we had huge numbers of inflation in the past. So if we compare Brazil from the 80s and the 90s and now, it's a great environment. Even though inflation is almost 10%, it's much better than it was before. Before it was 10% a month, sometimes even higher than that. But it's also hurting the society, the purchasing power of workmen. How does inflation nowadays play a role in your evaluation of businesses in comparison to what it was maybe back in the 80s and the 90s?
I think you're right. I think we are kind of pessimistic with the macro environment, but it's much better than it used to be 20, 30 years ago when we had hyperinflation, much higher volatility. Right? The thing is, companies are relatively good. Companies with pricing power are relatively good hedges. Right? The problem is that, again, pricing power in some businesses is eroding due to lower moats and more competition. So it's having pricing power isn't that easy as it used to be. Right? And so the best way for us as investors in equities is having a kind of balanced portfolio where you, instead of focusing on too much on the macro, you try and focus on the micro. The macro is always important because companies make much more money in a better macro environment than in a bad macro environment. Investors make much more money in a bull market with low interest rates than in a volatile market. Although people think that volatility is good for investors, it's not. We love a bull market with low interest rates, right? That's a bad environment. So what we do is try and focus on companies that have some specific stories or idiosyncrasies, right? Companies that are idiosyncratic. Easier said than done. All managers will tell you, no, all of my portfolio is idiosyncratic. It's you have some macro overlay, whether you want it or not. And the interesting thing is that the micro environment in Brazil is very, very vibrant. Right? And we've never seen so many M&As, a record number of IPOs, a record number of, again, mergers, right? New businesses. So, because again, Brazil is big, it's hard to compete in Brazil given all of the red tape and barriers of entry, so local businesses have an advantage. And they're growing, and so it's a paradox, because the macro is kind of noisy.
A lot of noise.
A lot of noise from the macro, but when you look at the micro, there's a lot of money to be made in great businesses. You don't have to buy the most recent IPO, speculative IPO. So what we're trying to do is focus on the micro and participate in the entrepreneurship, growth or beauty of the country.
But there are times. Please go ahead, Professor.
Can I add one thing to that? I like what Florian said about the macro and the micro, because I constantly talk to analysts around the world who get so focused on macro variables. What will happen to inflation? What will happen to interest rates? What will the government do? That they forget to look at the company they're trying to value. It's easy to get distracted. I'm sure all of you know the meaning of the word karma, but in valuation, I take a karmic view of some variables. For instance, when I value a company, I'm not going to sit there and wonder what's the Fed going to do next month, 6 months from now, a year from now. I don't control it. So I'm going to focus on the things I can control, that I can do my research on, and let some of those macro variables just roll through, because if I focused on them, I will have no time to look at the company I'm trying to value.
It's a great point. But I want to get your opinion, Professor, on something you've recently written about, and I've also watched some of your interviews regarding China and the political risk. And now that we see we have seen a more heavy-handed from the Chinese government, almost or instantly killing a whole sector, like the private education. And you've said that this risk has always been there, but perhaps investors just forgot about it. So how do you see this going forward, and political risk in general? How does this should be considered by investors?
It's time for some brutal honesty about China. China is it's a huge market. Every company wants to be in China. Every investor wants to be in China. But let's face it, when you invest in a Chinese company, the Chinese government is sitting at the table with you, whether you like it. They're an uninvited partner in your business. Now, for the last 20 years, the Chinese government has been an ally for Chinese companies. So when you bought Alibaba in 2014, or Tencent in 2017, or invested in Didi as a venture capitalist, the assumption was the Chinese government was on your side when you competed against foreign companies. In the last year and a half, we've discovered that the Chinese government, instead of being a friend, can be an enemy. And part of the reason for that is the Chinese government values growth. Obviously, they need the country to grow to keep the masses peaceful. But the Chinese government values something else even more than growth. They value control. I think what you're seeing here is a fear on the part of the Chinese government that the tech companies, the Tencents, the Alibabas, the JD.coms, are getting so big that the Chinese government will lose control of their own population. This is not about protecting your consumers. It's got not, if you think the Chinese government cares about consumers and competition, you also probably think that the People's Republic of China is actually about the people and is a republic. This has nothing to do with consumers and competition. This has everything to do with control. And I think finally we're seeing the other shoe drop. So I think it's time for a reassessment. Doesn't mean that Chinese companies are not good investments from now on, but it's time to be realistic about both the good side and the bad side of what the Chinese government can bring to the table.
Now, Florian, it's kind of interesting because we see in China is a very politically stable country. So there's not much noise. But when they decide something, happens what we've just mentioned with like the private education sector. In Brazil, in contrast, we have a constant noisy environment, new rules, new candidates, perhaps new policies. How do you manage the constant noise? Because sometimes the macro can affect the micro as well.
I think that the way we look at it is there are some. Imagine there are two tails. One tail is Venezuela, the other tail is, let's say, the US. I think that, look, when we get close to the tail of the US, there's a guardrail, that you said, the Brazilians say, no, you know what, everything's fine, the sense of urgency is lost. When we get, on the other hand, close to the guardrail or close to the abyss, people say, oh, wait, look, the country's too big, no, the business people here, the business people in Brazil didn't abandon Brazil as the Venezuelans or the Argentinians did. So there is no, we never get too bad or too good, right? So when we are between those two tails, everything should be relatively okay. And to Professor Damodaran's point, Professor, we have like two entrepreneurs here, several, but two that are very famous. One is Fred Trajano of Magazine Luiza, which is one of the largest e-commerce companies right now, worth dozens of billions of dollars. And André Stretti, who did a company called Stone, which also dozens of billions of reais. If you told them 10 years ago that, look, in the next 10 or 12 years, we're going to have a global financial crisis, Brexit, a pandemic, right? We're going to have President Dilma, right, in Brazil. She's going to be impeached. Then we're going to have President Temer, but then there's going to be a scandal. Then we're going to have a trucker strike. You know, GDP is going to collapse. GDP is going to go nowhere in 10 years in Brazil, in real terms, zero growth almost, right? And then we're going to have, you know, a lot of confusion, political confusion, blah, blah, blah. Maybe both, if they knew, they wouldn't have done what they did in their businesses, and dozens of billions of dollars would not have been created, right? So I say, look, if they had focused on the macro, maybe, if they knew, they maybe wouldn't have done what they did. So thankfully they didn't know. So again, the entrepreneur is always going forward, and focus on the customer, focus on your people, and going forward, hoping that we don't fall into the abyss, but knowing that also when we think everything is fine, maybe it's not going to happen because the sense of urgency maybe gets lost. So focus on the micro, and on your people and on your customer.
And over the long term as well.
I know, and long term. Absolutely, because yeah.
And can I add one more thing to that?
Please.
I think when you talk about the contrast between China and Brazil, you're really pointing to a contrast between a dictatorship and a democracy, right? In a dictatorship, a government can promise policies for the next 50 years and deliver. In a democracy, you're going to have constant change. And I've actually written a piece on which risk is better. Because in a democracy, you get constant risk. You got to live with the risk. You got to figure out how to build a business. In a dictatorship, you actually get lulled into a false sense of complacency, because it's not that you don't have risk, but the risk is discontinuous. Now, in Latin America, you know exactly what I mean by discontinuous risk, where you get regime changes and entirely rewriting the roots. I'm glad I live in a democracy with all the chaos that's embedded in it. I wouldn't want to live in a system where somebody promises me that the rules will not change for the next 75 years, because the only way you can do that is you have absolute power. And we know what absolute power does. It corrupts.
Professor, I have to confess I'm loving your brute honesty. So continuing on this path of brute honesty, let me ask you something now, shifting gears a little bit to the topic of ESG. You have been writing about it lately, and I want to start by asking you the following. Several decades ago, the economist Milton Friedman wrote the famous essay saying that the social responsibility of businesses was to increase profits. So as the meme goes nowadays, has this paper not aged so well?
Let me ask you a question. What else should a business be doing? Now, the ultimate end game for a business is to create value. You know what? That's not incompatible with doing good for society. In fact, in my post a couple of days ago, I wrote about two companies, Microsoft and Berkshire Hathaway. And Bill Gates built Microsoft from nothing to it. Now it's a $2 trillion company. And Berkshire Hathaway, of course, is the subject of legends. You know that both Bill Gates and Warren Buffett have signed a giving pledge, which basically means that they're going to take most of their substantial wealth, I think 95% of the wealth, and give it away during their lifetimes. And they've actually started delivering on it. They've made literally tens of thousands of shareholders wealthy. And those people have given back to society. So the first thing I take issue with is until ESG came along, we didn't care about society. Here's what I see as the difference in the old model and the new model. In the old model, businesses focused on being businesses, delivered value, and shareholders decided how much and where to give in society. In the new model, corporate CEOs and investment fund managers are going to decide for me as an investor or a shareholder what's good for society and how much to give. And it might be a better model, and I'm willing to listen to arguments, but I'm not willing to concede that it's automatically better for society. So what I want to do is start a conversation about ESG, because I think that it will be better as a concept if it gets pushed back. Because right now there's an incredible amount of laziness around the concept. And I think I see services pushing ESG scores, and I look at the scores and I say, that doesn't measure goodness. I see Larry Fink talking about ESG. And you know what? I'm going to say something brutally honest about Larry Fink. Listening to Larry Fink lecture me about morality is like listening to a serial killer talk about the value of life. Come on. This is rank hypocrisy. Okay? I think that we need, if you want to invest in good companies and you can show me that that goodness is going to pay off in value, there's nothing to argue. You've actually made Milton Friedman's case. If you're investing in good companies and you feel it'll cost them value, then be honest about it. We need honesty and less hypocrisy in this space. And I think we all share the same end game. We want society to be better. We don't want companies to create side costs for society. The question we're asking is, what is the best pathway to get there?
Florian, let me turn to you also on the same question, because you've been one of the pioneers, perhaps in Brazil, defending the thesis that companies should also, well, in terms of governance, I think it's pretty obvious. Any serious investor has been paying attention to governance forever. And in terms of social responsibility as well. But now we also have the E, which seems to be the more thorny of the three letters. How have you seen ESG evolve, and how do you see all the controversy regarding some of the pressures regarding you have to go ESG, everyone, now?
Yeah. So I think that, so how do we look at ESG? I think that, look, it's here. It may last 1 year, 10 years, 20 years, but you have to be cognizant that it exists and that some people make decisions based on it. Right? Whether you may agree with it or not, but some people make decisions about it. So you have to kind of, it's like the algo traders or robots. You don't use them, but look, you know that sometimes robots or algo traders are important, so you have to know that they exist and maybe sometimes adapt your strategy based on them. Right? Same thing with ESG. The way we look at it is, it is a lens we use. Why? Because it's some of the characteristics, if you will, or parameters, help us organize our investment process based on disruption. So what I like about it is, does a company have good governance or not? Which is, as you said, something we are born in Brazil. When you're a 12-year-old, when you're at 12 years, you learn about governance in Brazil, because it's in most emerging markets. So governance, social. So if the company doesn't treat their customers well, it's going to be disrupted. So it helps our analysts frame that. This is not ESG. It can be, you can call it whatever you want. It's pure good common sense, right? Nobody is going to argue about that. If the company doesn't treat the employees well, it is at a competitive disadvantage. So today, Nubank receives 3 times more curriculums from the best engineering universities in Brazil than the second largest bank in Brazil. Why? Because they are perceived as more inclusive, right? Because they want diversity, right? So for us, if you are not, if the company is not on the has a bad grade, if you will, for lack of a better word, in some of these characteristics, the risk of the company being disrupted is higher, right? So it's not like we want to, I want to have all of our companies ESG compliant, blah, blah. No, look, the company doesn't treat customers well. And this is as old as, I know, it's been valid for centuries, right? The company doesn't treat the customers well. But the problem is, a couple of decades ago, if you didn't treat your customers well, the risk of disruption was very low, right? It's not Uber that disrupted the taxis. The customers disrupted the taxis because they were pissed with the service. Right? So again, for us, it's a lens in which we look at the companies and look at the risks of the companies being disrupted. Right? And you have to be cognizant, because again, knowledgeable, but if you are polluting, the cost may be higher. If you're selling solar panels, you may have a tax break. So you have to know that. You may agree or disagree, but you have to include it in your investment process. And of course, just to, and there is now it's like tobacco. People have made a lot of money with tobacco companies in the last, I don't know, couple of years. Why? Because the stocks went down, they were very cheap, or people stopped. There's the green inflation risk now, because people stopped it's hard. People stop producing some things, and the prices rise. So again, you have to be knowledgeable of that. You may agree, you may not agree, but at the end of the day, it's here maybe for a while, and maybe it's old things just with a different I don't know, paint on it, right?
Can I respond to Florian? There isn't a single thing that Florian said that I would disagree with. Because, in fact, if Milton Friedman was sitting where Florian was saying, he would probably agree with everything. Because what did Florian say? He said, if goodness creates a better business model, makes your business more protected from competition, gives you more sustainable revenues, of course you should be good. I'll tell you what the problem is. 95% of the people investing in this space are not doing what Florian is doing. You know how they're investing in ESG? They're looking at the ESG score for a company that comes from Morningstar or MSCI, which first, you've outsourced your measure of goodness. Basically, you're letting them measure it, and God help you. You're investing based on those ESG scores, and you're expecting to have your cake and eat it too, which is, look, you're saying, look, I want to invest in good companies, and you know what, because I'm being good, I'm going to earn higher returns. Come on. Now, that's not ESG. That is not investing. That is playing another game with a metric. So I have absolutely no problem with people bringing goodness into the assessment of value of companies, as long as they remember the end game is this is still a business. In fact, if you look at the evidence on ESG, the strongest evidence in support of ESG is that bad companies are more likely to be punished. The evidence that good companies gets rewarded is much weaker. And let's face it, Vale and Petrobras have been damaged, perhaps irreparably, because they walked too close to the line. In the US, a Canadian company, Valiant, pharmaceutical company, damaged. So we know what happens when, so if I were advising companies, first I'd tell them, don't be bad. If they then said, should we spend extra money to look good? I said, don't spend money looking good. Do good. And if it's doing good will make you a better business, then you're doing exactly what businesses should do. My concern with this space is that some ESG proponents, and I don't think Florian is one of them, are going around promising the best of everything, that you can have your cake and eat it too. They're telling investors, you can just buy highly rated ESG companies and make higher returns. They're telling companies, if you adopt ESG, your value will automatically go up without, and they're telling young people, and don't take this personally if you're a young person, that they can be paid like bankers while working for the Peace Corps. Now, I know a lot of young people come to me and say, but I want to do good. You think you're unique? And people have always wanted to do that. 50 or 60 years ago, when people wanted to do good, they had to make a choice. Do you want to go work for a bank or do you want to go work with the Peace Corps? The choice was goodness will cost you. It'll mean that you accept less money. Unfortunately, people want to be paid like bankers and work like Peace Corps workers. That's not realism. And that's part of what I'd be pushing for is let's be open about the consequences of being good. And ultimately, if we want to create a better society, you got to start with the I, not the we. You have to ask, what can I do to make the world a better place? You know where you start? Buy products made by companies that you think pay their employees well, treat their customers well. Vote for the people that you think will create the change you want to see. Get involved in your community. What people want to do now is buy an ESG fund and say, look, I did my job. And then they get into their SUV, they drive back home and they've turned the air conditioning down to 60 degrees and they plan 3 flights to Hawaii while they're sitting at home. That's hypocrisy. So if we want to make the world a better place, the work has to start at home. And I completely agree with Florian. If you want companies eventually to be good companies, you've got to make it in their best business interest to be good. And I hope one day we'll get to that point.
Florian, you want to add something to?
No. I think that it's, Warren Buffett in the last couple of years has been questioned in the annual meeting about ESG. And he says, look, at the headquarters, we don't do much, but our companies, they do, but they don't tell you. But look, he asked the guy that runs the energy business. No, we have been doing this, and that. So he's not talking, he's walking, in the sense that he's doing, he's not talking. They're doing, they're not talking, And I also agree that what professors, one of the things he's probably afraid of is that when people do things that they don't understand, just because it's in fashion or because people are saying or some quote-unquote experts are telling them, you create bubbles and people get hurt. And, and this is bad. This is bad for ESG. So you don't want bubbles. So you want people doing the right things. But again, this is creating probably a bubble. And which is a bad thing because people are going to get hurt financially.
Let's talk more action. That's basically it, right? In your think about the people you know in your life who are really good people. The people I know in my life are really good people. Never spend time telling me how good they are. They don't tell me what they do, that they go to church on Sunday. They just do good. And that's why I'm skeptical. When companies spend half of their annual report telling you how good they are, I don't trust that. I mean, I am a skeptic when it comes to people who spend so much time talking about being good and spend so little time actually doing the things that make them good.
I do admire our open and honest discussion on the matter. So I want to also ask something about ESG, because I've heard one of the criticisms regarding it is that it's actually a rich country's problem and not a emerging market problem. And that sometimes the push for ESG can even hurt some poor countries. For example, preventing companies that produce coal or other kind of fossil fuels from getting financing in these countries. So these are some of the adverse effects that may emerge, and people seem to be overlooking the adverse effects of ESG. Do you agree with this?
No, I think that it's everybody's problem. I don't agree that it's a developed market problem or just a rich country's problem, but I do agree that the impact is disproportionate. And it seems a little unfair, right? I mean, kind of people in the US and Western Europe have benefited from oil and coal power to improve their standard of living. It seems hypocritical that we should now wag our fingers at Indians and Chinese who want to buy cars which might be gas guzzlers or use electricity to run their refrigerators and their air conditioners and say, you shouldn't be doing that. So I think if we want to create a better world, we need a more equitable sharing of the sacrifices. And as you can see already from the Paris meetings and since, that's not going to come easily. Nobody wants to give up what they already have. And that is, again, part of the hypocrisy in this process, which is rich people gather together in Davos and talk about all these solutions. But then they go back to their homes and they don't want to follow through on the sacrifices so they're intent on making other people sacrifice for their good intentions. And that's not going to breed a whole lot of goodwill in this process.
Thank you very much. Let me shift gears again now to something that has been happening in the past decade, more or less, since 2009, when Bitcoin was created. And we have seen this alternative financial system being born and developed side by side, and seems to be gaining a lot of traction all over the world, and having immense consequences in capital markets, in financial system, in banking, and even money itself. Starting with you, Florian, how do you see the whole space developing? Do you think there are opportunities? What are the traps, perhaps?
Look, what I see happening is starting from the consumer. Right? When you look at the, let's say, computer scientists or developers, they want to trade 24/7, and the only thing they can trade 24/7 is Bitcoin, and they want to do it with a push of a button. They don't want to say, they don't want to buy Petrobras, right? They don't want to buy CVRD, iron ore, right? They want to buy the future. It may be Bitcoin or maybe another asset, right? So I think that's one challenge for the system. The new consumers, which are going to be the investors, they want to do 24/7 in 2 seconds, whenever. Dream of the libertarian, right? I don't know if it's in English, the supranational currency. So I'm curious, I love it, and it's been driven by the consumer or the new investor. It's not been driven by, and the most interesting thing is, I'm on the board of a stock exchange, right? So, and I talk to a lot of people in finance. So, some years ago, the 50-year-old guys, no, Bitcoin, this is for the mafia. This is for the black market, right? And now they say, no, maybe we should look at it, blah, blah, blah. So this is driven by the young people, and they're the future. I don't know how it's going to end. And the beauty of this is the disruption. It's ask for forgiveness, not for permission, right? So Bitcoin is asking for forgiveness, not for permission. And everybody thinks that, no, governments are going to intervene, they're going to blah, 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 and it's already too big. Maybe it's already very big for governments to kind of intervene. I don't know, but it's fascinating. But I'm much more of an observer of history, a fascinated observer than a participant in the story.
Very good. Professor, we still have a few minutes left, so I want to also ask you the same question, and starting by asking you, have you already bought your first NFT?
And let me back up. Let me start with Bitcoin first, because NFTs are an interesting side game, but Bitcoin obviously has, even if it's not really, if you think about it, the attention we pay to Bitcoin is vastly disproportionate to its actual place in the economy, right? The collective value of all cryptos put together is less than the market cap of one company, Apple, right? Less than 2 trillion. And think of how much time, energy we've spent talking about it. And there's a reason for that. Now, I've described Bitcoin as a currency created by the paranoid for the paranoid. What I mean by that is it's a currency created where you trust no one. That's why you need miners to check every transaction, because you don't have a central bank. And that makes it a very inefficient currency. It's a great speculative trade. Let's face it, a lot of people, when they talk about Bitcoin, talk about how much money they make. But the number of transactions actually that happen in Bitcoin. In fact, I talked to a group of 1,000 Bitcoin enthusiasts in Asia a couple of years ago and asked them a very simple question. How many people in this audience have actually used Bitcoin to actually buy something? A house, a car, their lunch? Less than 5%. And these are Bitcoin enthusiasts that actually use Bitcoin to buy something. Every single person in that room was trading Bitcoin, but they were not transacting in Bitcoin. I know El Salvador now claims to be a Bitcoin haven, but when the country you point to as the country that adopted your currency is El Salvador, you're really scraping the bottom of the barrel. Because if that's your end game, to become a currency for failed countries, I don't think you want to be a currency. So my problem with Bitcoin is specific to Bitcoin. I do think cryptocurrencies will be in our future because everything we do is digital. Why should currencies be any different? I just don't think Bitcoin will do it. It's just a badly designed currency and inefficient. On NFTs, I agree with Florian. I mean, NFTs are like Picassos. It's in the eye of the beholder. Now, so I think what you're doing is, if you're an art collector, the way you decide whether to collect art is you learn a lot about art. So maybe if you want to go into the NFT space, you should spend a lot of time thinking about what it is that will make a media clip, a video clip of Michael Jordan slam dunking a ball, become one that lasts for the next 200 years, whereas a clip of LeBron James will fade. I don't have those skills, and like Florian, since I don't have those skills, I'm not going into that space, but I understand why people are going there. And it's actually related to what you said about low interest rates. Low interest rates are driving us into I don't even want to call them asset classes, to putting our money into things we would never have thought about as reasonable investments 20 or 30 years ago. The search for yield is driving us to desperate places. And NFT might be one of those desperate places.
Very good. We have run out of time. Florian, thank you very much for your time. It's been a fascinating discussion. Professor Damodaran, thank you very much. It's been really great. Thank you. Thank you for the audience as well.
Thank you. It was fun.